The tax deadline is just around the corner. How will your bonds be taxed, especially if you sell before maturity? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, as many of our Diamond NestEgg regulars already know, how the interest on different types of bonds is taxed depends on the type of account that they're held in. For example, interest earned on treasuries is exempt from state and local taxes when held in a normal taxable brokerage account, but taxed as ordinary income upon withdrawal from a traditional retirement account. So, with that in mind, here are the 3 topics I'll be covering today. 1. What counts as interest and is taxed as interest by the IRS and other tax authorities? 2. Is interest taxation different for bonds purchased on the secondary market? And 3. What happens when you sell a bond early? Let's dive in now, folks. What counts as interest and is taxed as interest by the IRS and other tax authorities? So this can sometimes be complicated and confusing. It may be instinctively clear to many of our Diamond NestEgg fans that the coupon payments every 6 months that most treasuries and other bonds carry are considered interest and taxed as such. But these may not be the only interest payments in the eyes of the taxman. If you hold a bond to maturity, the difference between the purchase price and the principal repayment may also be treated and taxed as interest in many cases. For example, T-bills and Treasury zeros don't pay regular coupons. Rather, they're initially issued at a discount, meaning sold for less than their face value, what the IRS calls an original issue discount, or OID. And when such bonds mature, the difference between the smaller initial purchase price and the larger principal repayment at maturity is essentially your interest payment, and it is generally taxed as such, as interest income at your full marginal income tax rate, and not at the potentially lower capital gains tax rate. But what if you buy a bond at a discount on the secondary market? Is interest taxation different for bonds purchased on the secondary market? So, the same basic rule applies if you buy a bond at a discount on the secondary market. If you hold the bond to maturity, then the difference between your purchase price and the principal repayment at maturity will again be treated like interest income and taxed at your full marginal income tax rate. The principle behind this is that the taxman wants to treat all guaranteed income earned from a bond the same, because it's essentially interest regardless of whether it gets paid out as a regular coupon over the life of a bond or as a one-off at maturity. Now, the detailed rules about taxation of discounts can be complex. For example, a discount that you get when you buy a new bond at issuance, the original issue discount, or OID that I mentioned before, may have to be accrued every year as so-called phantom income, while a discount that you get on the secondary market may only be taxed at maturity. And municipal bonds live in an entirely different tax world altogether. We discussed munis and the de minimis rule at length in the municipal bond module in our bond beginners course. And if you're interested in our popular bond course bundle, which includes our foundational level bond beginners course, as well as our intermediate level bond masters course on how to build a bond portfolio, use coupon code INCOME2026 to take $100 off your purchase before midnight Eastern Time on Sunday, March 1st. For 2026, we've upgraded our courses to lifetime access. I've included the links below this video for your convenience. And if you already understand some of the basics of bond investing, I'd like to invite you to become a part of our VIP investment club, where our members have daily conversations with me, Marcus, and one another on the best rates and investment opportunities that they're interested in right now. Some of the most popular chats at the moment revolve around tax exemptions for treasuries, some agency bonds and munis, but also how you can make sure that you properly reflect these when you prepare your tax return yourself with the help of TurboTax and H&R Block, which shouldn't be surprising given that the April 15th tax deadline is around the corner. We hope you will come join us and our VIP members before it's too late for this tax year. The $100 coupon code INCOME2026 can be used to join our bond courses and our VIP investment club as well. And for the latter, quarterly, if you want to test it out, semi-annually if you want to stay flexible, or annually if you're like practically all of our VIP members and want the best value. For now, though, let's get back to the taxation topics at hand. So we covered some exceptions, and while it's good to know that these exist, let's go back to the principle here. The basic rule is that any bond that you hold to maturity will have not just all regular interest payments taxed at the full marginal income tax rates, but any difference between the purchase price and the full principal repayment at maturity, any gains from buying the bond at a discount will be treated and taxed as interest income as well. So, if you're a buy and hold investor, you should, under most circumstances, not really see any capital gains for tax purposes. But what if you need or want to sell your bond before the maturity date? How do the IRS and state tax authorities handle this situation? Bringing us nicely to the next part of today's discussion. What happens when you sell a bond early? So, if you sell a bond early on the secondary market, you'll usually have a capital gain if you sell a bond before its maturity date for more than what you paid for it because you've made a profit. And you'll usually have a capital loss if you sell a bond before its maturity date for less than what you paid for it. After the end of the tax year, your brokerage firm should provide you a Form 1099-B with any bond sales that took place during the year. Form 1099-B will also provide you and or your tax advisor with the information needed to report capital gains or losses on your federal and state income tax returns. Capital gains are taxed at different rates depending on whether they're short-term or long-term. Short-term capital gains apply if you hold a bond for 365 days, 1 year basically, or less, and sell before maturity on the secondary market. At the time of this taping, short-term capital gains don't really enjoy any special advantages, but are typically taxed at your ordinary income tax rates, which range from 10% to 37% for federal purposes, plus any applicable state or local taxes on top. Long-term capital gains, on the other hand, are potentially privileged. If you hold a bond for more than a year, long-term capital gains are typically taxed at reduced rates with 3 applicable tax brackets of 0%, 15%, and 20% for federal purposes at the current time, depending on your filing status and total taxable income for the year. And any applicable state and local taxes will come on top as well. And if capital gains are relevant to you, you should check what the short-term and or long-term capital gains rates look like for you and in your state at the time you're watching this, as they may have changed. So, that was how short-term and long-term capital gains on bonds sold before maturity are taxed in a taxable brokerage account. With capital losses in taxable accounts, you should usually be able to use those losses to reduce your taxes. In the year you incur the losses, you can use them to offset any capital gains from the same year, and without any limits, as the IRS, to say it in a slightly simplified manner, will only tax your net capital gains. If your capital loss exceeds your capital gain in a tax year, you can also use it to offset your ordinary income, but only by up to $3,000 per year, or $1,500 per spouse and year for those married filing separately. Any remaining losses can be carried over without a time limit to offset future capital gains as much as you have them in any year. And the remainder of the carried forward losses can again be applied up to either $3,000 or $1,500 per spouse per year against your ordinary income. If this is relevant, you should check what these numbers look like for you and in your state at the time you're watching this, as they may have changed. So, those were the general rules for short-term and long-term capital gains or losses in a normal taxable brokerage account. Moving on now to tax-advantaged accounts. With both traditional and Roth IRAs, taxes are deferred until a distribution is made. As a refresher, assuming you meet all the relevant requirements, all distributions from a traditional IRA are taxed as ordinary income. And all distributions from a Roth IRA are not taxed at all. As a consequence, because the taxman treats them just like any other income at distribution, even long-term capital gains are not privileged in tax advantage accounts and will not play a major role in how you structure and develop your bond portfolio. And as a friendly reminder, all the information that we've just presented is general and educational in nature. We are not tax or legal advisors, nor are we your financial advisor. And the rules about bond taxation can be complicated. For example, it can require some detailed analyses to separate out what part of the profit of a bond sold on the secondary market will be taxed as interest versus capital gains. So, if you have more specific questions at this point that are particular to your individual circumstances, goals, and expectations, please do consult with your trusted advisor for your personal situation. And if you're ready to jumpstart your fixed income journey with us, remember to use coupon code INCOME2026 to get $100 off of our popular bond course bundle, as well as our VIP investment club, and be a part of the daily conversations that our VIP members are having about money, investing, and retirement. Visit our website at www.diamondnestegg.com and select the option that interests you most to learn more, or see the links below this video for more details. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed this video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.